Hello and welcome back with another special series of Global Insights with me, Punita Kumar Sinha. Over the next 6 weeks, we will try to do an in-depth analysis of the macroeconomic cues that impact world markets over the near term. We start the show by discussing emerging cues from Europe, where the weather this year, as well as the economy, has been a cause for concern. The key questions we want to discuss are: how fragile is the Eurozone? What will drive growth in Europe? And will the euro weaken to push exports or strengthen as the investment picks up? Joining us today to discuss the future of Europe are Nikhil Srinivasan, CIO at Generali, joining in from Milan, Italy, and Erin Gibbs, Equity CIO, S&P Investment Advisory Services, joining in from New York. Welcome, Erin and Nikhil. Nikhil, my first question to you: do you think that the Eurozone itself is going to survive over the next few years? I mean, the future of Eurozone to me looks pretty fragile. What's your take on it?
No, I don't think the future of the Eurozone is fragile. I think that, so if you ask me, will the Eurozone survive for the next few years, my answer is yes, because at the end, what people sometimes miss is the fact that this is as much a political creation as an economic creation, and the politics for the Eurozone today remain strong. Having said that, there's been a lot of differences that have opened up, particularly given what's happened in the last few days with Greece, and so those differences have to be mended. But the political will to have a Eurozone remains, and if the political will remains, there will be a Eurozone, and I think if you ask me, well, will it last for the next few years, and that was your question, I said yes, it will.
So, Erin, do you think that Eurozone will survive, or is there still risk there?
I think, looking after these meetings, there is certainly conviction that that the Eurozone is going to survive. They are definitely committed. Certainly, Germany is certainly very committed, and I think the fact that even having an open debate has obviously been healthy for the Eurozone, and I do see this being still a very strong economy going forward.
Erin, as you've seen, the equities did well on the news that the Greece bailout is happening. But the euro has weakened since then. Where do you see the euro going? And where do you see the disparity between the equity markets and the currencies?
We do expect certainly more stability going forward, as we're expecting some of the Fed tightening that tends to reduce the dollar. So any of the interest rate changes could create more fluctuation. But over the last 6 months in 2014, early quarter 2015, there was obviously a huge move of the euro across of a large basket of currencies, and in particular the dollar, about a 15% move. I want to make it clear, we do not expect that kind of move again. I expect the euro to trade more in a normal range. It might slightly appreciate against the dollar as we see, again, tightening in the dollar, more quantitative easing in the euro. But still much more of a stable rate going forward. The dollar could appreciate, certainly, and we could see more appreciation, but nothing like what we've seen in the past year.
Nikhil, would you be overweight European stocks today?
Versus, if it was versus Asia or the US, probably yes. If you just gave me those three zones, if you just said emerging markets, US and Europe, I'd be overweight Europe. Because you've got to remember, I mean, the valuations are still cheap. Earnings aren't great, but you could argue cyclically they should do better. They didn't have the US situation where you've had a lot of buybacks that have propelled the markets up here. The European companies tend not to do buybacks, they tend to pay dividends, so you've got a decent dividend yield. You're not, even though the euro has dropped in the last 12 months, I'd say the euro is a currency that will probably outperform many emerging market currencies versus the dollar. Having said that, I'd probably be long Europe on a hedged basis on a 3-year view, meaning that I would probably do a currency hedge against my European exposures if I had a longer term view.
Nikhil, you seem pretty positive on European export growth, and with the weaker euro, we'll probably see more exports. So are you investing more in the exporters or the domestics?
No, you do both, because remember, I mean, what's been happening in Europe slowly is an internal devaluation. So even though the currency hasn't moved that much beyond that move against the dollar, the currency remains stable at 111 or whatever it is today, 110. I'd say that, overall the export companies did very well, particularly the German exporters in the last, they did really well even before the move with the currency devaluation because China was booming. But export is as much a factor of currency and efficiency and productivity as it is in terms of demand. I think demand from places like China has slowed down, so you don't really want to be big into the large exporters in Europe. You really want to be more domestic if you were going to own European stocks today.
And Erin, would you invest in exporters or domestics?
Oh, so for certainly the weakness of the euro has been good for exporters, but even with the currency effects, I don't take that into account as much. Though they are mostly, because they are mostly an importing nation, so it's not like some of your more developed markets that are much more dependent on the exchange rate. So things actually, so as the euro goes down, actually, obviously their imports become more expensive. So on a balance, on a net, I think it's a slightly neutral effect overall.
And Erin, how are you looking at earnings growth in Europe then over the long term?
Well, I don't typically look that far out by years. I am a long-term investor, so for us that means 6 to 12 months. And so for us, we're looking at earnings growth over the next for over 2015 and 2016. For 2015, we're looking at about 10% earnings growth for the S&P Europe 350, which is very respectable, particularly when you look at other developed markets like the US, where it's looking at almost flat earnings growth. And for 2016, they're looking at about 12% earnings growth. Again, low single digits is very respectable, very good. And also the valuations are very attractive. And that's about on par with the US. So we definitely see potential for assets to shift from the US into Europe. Also, when you take into account the tightening that we're expecting in the US and this is more a 6-month outlook, versus the quantitative easing that we have in Europe, there certainly are advantages to putting investments over in Europe versus in the US. Typically, when there's tightening, at the very beginning, it tends to be a negative shock for the equity markets. So this tends to be short term. It flushes out after 6 to 9 months or so. But nonetheless, that means that we are expecting some downside in the US when we see some final tightening from the Federal Reserve versus the ECB that's offering more and more quantitative easing. So my outlook is a little more 6 to 12 months, not so many years, but certainly there are definitely positives on Europe relative to the rest of the major developed markets.
Nikhil, do you expect the euro to strengthen from here, or do you expect it to weaken in the long run?
I would say that in the short term, the euro is in a range. I'd say in the long term, I expect it to weaken.
And why do you expect it to weaken?
No, because, I'd say, you've got the Fed that's starting its cycle of tightening, even if it's gradual. So that gives you a dollar bid, which wasn't there necessarily. So that's one very strong reason. Two, I think Eurozone growth is not going to be phenomenal in the next year. Despite the export growth we just talked about, I think Eurozone growth is going to struggle in the next 18 months. And it'll be better than, say, some countries will do better than the last year or the year before last, but overall, I think the German engine is slower, which has been a big driver of Eurozone growth. And even the places like Italy and France are doing better than last year. They're not doing phenomenally better. So I'd say Eurozone growth actually is going to end up being modest, and that's not going to be great for the euro as well.
We've been trying to stress to investors, particularly our U.S. investors, is to really look outside the U.S. for growth, and also in different market cap classes. So there are quite a few companies we like. One of our favorite companies is Sanofi. It's a French pharmaceutical. It's actually one of the largest pharmaceuticals.
Trends that turn like this in markets don't just last a year. So I'd expect the outperformance to continue for another year or two for sure. But it may not be phenomenal, is all I'm going to say, yeah.
Erin, you've talked about the fact that while the Fed raises rates, QE in Europe is here for now. So do you see a lot of opportunities emerging from the bottom-up work you're doing on European companies versus US companies?
Yes, exactly. And that's one of the things that we've been trying to stress to investors, particularly our US investors, is to really look outside the US for growth, and also in different market cap classes. So there are quite a few companies we like. One of our favorite companies is Sanofi. It's a French pharmaceutical. It's actually one of the largest pharmaceuticals outside the U.S. They bought Genzyme a few years ago. That has really been the catalyst for growth for them. They also have a new CEO who came on board in February. He has a very good experience in the U.S., and they're really trying to expand more into the U.S. markets. This is one of those companies where you can get really good growth at a much more reasonable valuation than you can within the U.S. markets. And it has been one of our favorites. And there are quite a few examples that we see that in Europe where you can take advantage of the volatility that we've been seeing recently, but you see very solid growth, very diversified revenue streams, and real opportunities for appreciation over the next 6 to 12 months.
And Nikhil, do you think Europe will outperform like it did over the past 1 year, particularly versus the US?
Good question. I mean, on balance, I'd say yes, but they both may go down, and it'll be a relative outperformance. So I'd say, you know, trends that turn like this in markets don't just last a year. So I'd expect the outperformance to continue for another year or two for sure. But it may not be phenomenal, is all I'm going to say. Yeah.
Erin, you said that the growth in Europe is almost similar to that of the US, but the valuations in Europe are a lot better. So how do you see this recovery in Europe, and how do you think it should be priced?
Sure. So earlier this year, the S&P Europe 350 index actually peaked at valuations at about 7.5 times forward earnings, or the next 12 months earnings. Right now, it's come closer to a little above 16 times forward earnings, which is actually a good entry point as we see it. Now, just to give you an idea of a comparison basis, the US has been trading at a range of about 18 times forward earnings to a little over 17. So they're definitely trading at a discount, but you're getting much better growth over in Europe. So we really see this as a good value opportunity. Right now, the S&P Europe 350 index is trading at about its 6-month average, which may seem like it was more that it's a decent value, not a great value, but because we are seeing such good growth over the next year, we feel that valuations can actually be a little higher and do see this as a good entry point.
But 11% growth at a 16 times multiple doesn't seem that compelling.
It is. It's very compelling. I mean, compared to versus the U.S., where you're looking at 0% growth to maybe 5% growth and 17.5 times earnings, it is very compelling.
So Erin, would you be buying high-yielding bonds of different sovereigns in Europe or not?
So overall for high-yielding, they have done particularly well over the past 3 years, but the spreads have really peaked over the past 3 months. So I don't think this is exactly the time to get in for high-yield bonds. But overall, as an asset class, when we're just looking at more at equities versus bonds, we still see attractiveness, particularly with the pullback over the last month.
So you're saying that you prefer equities to bonds in Europe, and you prefer European equities to US equities?
Exactly. Certainly, when you look at the risk-adjusted returns, you get pretty minimal returns, particularly with some of your high-yield bonds in Europe, and there's still a lot of volatility and enough credit risk, versus some European equities offer 6-7% dividend yields and similar volatilities on par to those of the high-yield bonds. So we do see a lot of opportunity with the equity markets, even when trading at higher valuations.
Nikhil, about a year ago, you had increased allocations to European equities. Today, how do you see the risk reward in European equities versus European debt?
Yeah, actually, we increased our exposure to Europe significantly almost 2.5 years ago. In the last few months, we've kind of reduced our exposure to the Eurozone. I'd still say Euro stocks are reasonably priced. I think part of the reason we reduced our exposure was just the uncertainty surrounding what you talked about at the beginning of this conversation. Now that that's settling down, I think going into the latter part of the year, Europe becomes attractive again, I'd say. So we'd probably increase our exposure in. But again, it's not so much even exposure, it's more about when markets reach a certain point, you really want to be much more idiosyncratic, you want to be more sector specific, you want to do private market stuff, you want to do things that are not just buying the index, right? And I think the index story is over, as far as I'm concerned. You can make a lot more in return by doing other things. I think European debt is fairly priced here. I don't think you're going to get much upside in terms of capital appreciation from European debt, but I think it's I don't worry about defaults, and I don't worry about the things other people might. I just think that a lot of the capital appreciation has happened.
So Nikhil, you mentioned earlier that you've been reducing allocations to some sectors in the last few months. Where have you been increasing your allocations?
Yeah, but it's a near-term tactical move. We'll come back to the markets, but I think overall, I don't find we were long China. We're not long so much China anymore. The US, we're sort of neutral. The small markets look interesting. I think actually the Indian equity market's starting to look interesting again, but it's gone up so much that you wonder. I think the Vietnamese market looks very interesting in Asia, but these are markets that are too small for us to deploy huge amounts of money for Vietnam, for example. And so, overall, you have to be much more idiosyncratic about your equity approach than you were, say, 2 years ago or even a year ago, and look for opportunities, meaning you have to work harder to make money.
So, Nikhil, would you allocate more to Europe, US, Asia, or India right now?
No, I wouldn't. I mean, these are very big regions. I'd say that I would allocate, for the rest of the year, I'd probably allocate more going through, assuming all these things settle down in Europe and the summer's over, I'd be allocating more to Europe versus the US. And overall in Asia, I'd be neutral in Asia, but I just don't see huge amounts of upside in Asia.
So Nikhil, if we have to look ahead 3 years, where do you think we will be with respect to the Eurozone? Will it survive? And do you think that European equities will continue to perform well like they're doing today?
Yes. I would say that the Eurozone definitely survives. The Euro is likely weaker. And at least for the first part of those 3 years, I don't want to take a 3-year view on a market, on equity markets, but I'd say the first part of that, I think European equities, particularly Southern European equities, have done better than many markets around the world. But that's the first part of it. The second part of it, who knows what happens from a policy point of view in year 2 and 3. I mean, the main thing to remember, what's going to keep an underlying interest in European equities is that I don't see the ECB being able to raise interest rates for several years to come. So they're very much, the cyclical move in the US, the cycle's turned on the Fed, so I think you'll have interest rate increases probably starting this year and gradually next year. I don't think the ECB is in a position to do that for a few more years.
So you think, Nikhil, that the euro is going to parity with the dollar?
Well, I don't. As I said, it's probably range bound in the near term, but it would not surprise me if we go to parity. In the next couple of years. So I wouldn't be surprised.
So, Erin, my final question to you: do you think the situation is going to be fairly stable and the worst is behind us, and that we shouldn't worry about volatility, but it's time to ride it out?
Yes, I think this is absolutely not a time to panic. I see this volatility truly as an opportunity. Europe really is in a much stronger position. Even if Greece did exit the Eurozone, they really are in such a much stronger position than they were beforehand. And again, when we're looking at the CDS markets, when we're looking at a lot of markets that indicate the overall risk of Europe and economic deterioration, and we really don't see any spikes. We have throughout this entire process, we have seen CDS volatility stay in fairly stable ranges and still stay within historical norms. We haven't seen any huge spikes up. So when we see the stock market go down, of course, we do see this as more of an attractive opportunity to get into those positions.
Well, thank you all for joining us on the show today.
Thank you.
Thank you. Bye-bye.
As we've heard from all our guests today, Europe is recovering and throwing up interesting investment opportunities in the area. Tanveer Gill now joins us to analyze the key market trends there. Tanveer, Europe has been an outperformer this year. What is the data telling you?
Yeah, just like last year, actually, Europe is a standout story this year as well. You have the Euro stocks, which has actually gained 5% this year from a year-to-date perspective, and that's thanks to really the CAC and the DAX performance. You've also had the Swiss market that's done really well, so 8% higher there. Some of the peripheral markets have also performed, surprise, despite all the mayhem and confusion that came by due to the Greece issue. The interesting highlight is what the euro has done, because remember, this debate is really about the euro and what the single currency regime would mean for all the member nations. And for a 52-week chart, if we were to just pull that up, we've seen the euro actually come off quite substantially from 1.35 to sub 1.1 levels. In fact, its 52-week low on the euro is as close, and we were talking about parity between euro dollar, is as close at 1.04. So that clearly has been one indicator that suggests that exports have picked up because the currency has been very favorable, and we've seen that in the German data too, and for France as well, where exports have been a key driver for their growth and their recovery. And that brings me to my question to you, Punita. How are you mapping Europe at this juncture? Given the concerns in deflation, given the concerns of high debt, deleveraging is not played out, how does Europe stand as an investment opportunity?
Tanveer, as your data is showing, Europe has actually outperformed quite well. And I think the main reasons are actually about three. Simply put, first, valuations in Europe got very attractive compared to some of the other markets, particularly the US. Second, QE in Europe is happening while US, as we know, is looking to withdraw the stimulus. And the third is the weak euro. And that's really caused a lot of exporters to do well. So all of those three reasons has caused the European equities to do well, but the concerns haven't gone away. It's a marriage that was based on monetary convenience, but the fiscal problems and the fiscal consolidation across the countries hasn't happened. So when you're in a bad marriage, at some point it might break, and that's what we are seeing. We are seeing lots of pushes and pulls. After all, how long is Germany going to keep supporting Greece? Although, as you've said, Germany has benefited from the weak euro as well, and its exports have done well. So it's not all that bad. But, the Eurozone it's not more than 20 some years old. And before there was the Eurozone, countries were on their own, and there could be a time where we may see that again.
That'll be a long drawn process, I would imagine. But talking about the comparison between the US, where the US is in its economic cycle, to where Europe is right now, how do you draw the parallel? Does it seem like the US is a crowded trade right now with the dollar, with the equities trading at record highs, and Europe perhaps would be the contrarian?
Well, first of all, I wouldn't say that Europe is a contrarian trade anymore, especially given the data you've shown. Yeah. It's already outperforming several markets, outperforming India. So I don't think it's a contrarian bet. But yes, I think with the weak euro, there are going to be entry points for investors to enter the markets. But there's going to be a lot of volatility in my view, because as you said, high debt and deflation and other concerns in Europe haven't gone away. So the worst is not over. And so as we see volatility, we're going to be able to find, investors are going to be able to find good entry points. They're also going to be able to find good exits. So I think for now, definitely there is potentially more opportunity in Europe, given all the problems that we see there.
So basically every crisis throws up opportunities.
Yes, absolutely. It always does. With that, we come to the end of this episode of Global Insights with me, Punita Kumar Sinha. We will come back next week and discuss the China story. Is the economy poised for a well-balanced transition, or are there worries ahead? See you next week with another intriguing discussion with a strong panel of Chinese experts. Thank you for watching.
We are looking at late 2015, even early 2016, to see a greater degree of stabilization of the Chinese economy, really starting to respond to the monetary stimulus that we've seen in China, which has been implemented since the end of last year.
China would actually be a very good allocation to have in your portfolio. The bond market will remain supported by stable inflation and lower growth and policy easing measures, and the currency will remain one of the most resilient currencies in the EM world.
Find us on Facebook at facebook.com/etnow, and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.